think that we will get started in the interest of time, and as other people turn up, we'll proceed. So, I'm Jordan Green. For those who don't know, I'm the founder and president of Melbourne Angels, and I'd like to welcome you today to our Angels at Noon event. I just want to tell you a little bit about Melbourne Angels and why we do what we do. First of all, I'd like to acknowledge the organisations who support us. It's very important. We're an all-volunteer, not-for-profit activity as a group, so having the support of these organisations is really very important. A little bit for those who may not know about Melbourne Angels. We're one of the most active startup investors in the country. We typically do in excess of 20 transactions a year, which totals in the order of about $3 million every year, and we've been doing that for a long time, over a decade. We currently have in excess of 85 active members and more than 75 companies in our portfolio. We meet to have companies pitch to us twice a month for 11 months of the year. So that's 22 meetings a year. Over the time we've been doing this, we've made in excess of 600 individual investments. That's for a total in the order of about $30 million that we've invested. And typically when we're investing in a deal, it attracts other capital into those companies. And so our estimate at the moment is that at least $180 million of additional capital has been invested in those companies. One of the things that we think is most important is that we're helping to grow the economy in every way. And one measure of that is the more than 600 skilled jobs that we've been able to help fund through the investments that we've made. Through our portfolio, we've had 9 exits. Only one of those has been an ASX listing, and it certainly isn't our most successful exit. But maybe we'll hear a little bit more about that in the talk today. But why angel investors, and why are we doing it in Melbourne? Well, for those who don't know, Australia has at least 17 unicorns. 10 of those have been angel-backed at the beginning. 11 of them were founded in Melbourne, and 6 of them actually dominate their industry segment globally. So that's a pretty good reason to be doing angel investing, and angel investing in Melbourne. Of the M&A exits that we've had in Australia over the last 3 years, that have been for more than $5 million in value, around 70% of those were angel-backed companies. Just under half of those were founded in Melbourne. So if you're looking for a company that could be exited positively, the majority of them in Australia start in Melbourne. 85% of those successful exits had no venture capital investment in them at all. And 90% of those that delivered the biggest returns to the founders and early investors also had no venture capital in them at all. And on another occasion, if you're curious, I'm more than happy to talk to you about the parallel paths of investment with angel investment, venture capital, private equity, etc. So we do encourage you to become a member of Melbourne Angels if you're interested, or to share the opportunity with other people who you think might be interested. When you join the group, you get a whole range of benefits. And as you can see, measured by the National Angel Awards program, oh, I've gone backwards, didn't know I was going to do that. We've been winning the awards over the 3 years that the program's been running. This year, most interestingly, we got the Best Exit Award. We do this Angels at Noon every month except December. We've been doing it for well over a decade. This year, of course, we've been running these virtual events. We assume that next year we will return to having our end-of-month lunch event where we can do a lot of in-person networking, but we're also going to keep the virtual events as a feature of our programs. So I hope that you'll look forward to joining us either in person or online as we continue with these programs. And our first Angels at Noon event next year will be on January the 29th. And if you're on the mailing list, you'll get an email all about that. For the meeting today, well, actually one more thing I should remember. I want to wish you all the best for the season, since this is our last public event. So season's greetings. We're moving into a very interesting summer here in Australia. Hopefully it will be a pandemic-free summer and we'll have a wonderful experience. Hopefully no fires either. But looking to 2021, I think it's going to be a really interesting year for all of us. And certainly from all of us at Melbourne Angels to all of you out there, we'd wish you the 2021 a year of great positivity, great hope, and wonderful new opportunities to do things in a new and different way for success. For the meeting today, when we get to the Q&A session, everybody is welcome to ask Q&A, of course. I would ask that if you're able to, just click the participants button in your Zoom dialogue and use the little blue hand there to indicate that you'd like to ask a question. And that way we can make sure we get to everybody who wants to ask a question. So today we're going to hear from a good friend of mine, Nelson Gray from Scotland. He's sitting in Edinburgh and he's up at 1 o'clock in the morning to talk to us. So we really appreciate, Nelson, that you've done that. Now, like myself, Nelson has been an angel investor for around 25 years. He's a member of groups in Scotland and the United States, including Archangel, which is one of the oldest angel groups in the world. It was founded in 1992 in Edinburgh, and Nelson has both been a manager of Archangel and remains an active member of the group. He's personally invested in more than 50 companies, and he's invested in at least a further 50 companies as the manager of a government-regulated fund. And he currently serves on the investment committee of the UK government $180 million angel co-fund, so a co-investment fund for angel investments. Of his 50 personal investments, 23 are still alive. It indicates 2 of those are less than 3 months old, so he's still an active investor. 10 of his investments have managed a positive exit, ranging from a return of his capital to 92 times his investment. He's also been an active advisor working with organizations like the World Bank and the European Commission and others to provide advice to governments on policy to stimulate angel investment, and also training angel investors in many countries. He specifically helped initiate and grow angel groups in Scotland, in Latvia, in Jordan, Russia, Egypt, Georgia, Ukraine, I think is that, and the Caribbean. Nelson was awarded European Angel of the Year by the European Business Angel Network, the Pan-European Angel Community. And he has also received in 2015 the Queen's Award for Enterprise Promotion for all of his work in the angel space. And his personal investment thesis is centered around the idea of strategic angel investing and obviously creating entrepreneurial wealth. And today he's going to talk to us from the perspective of the latest news around exits and how he sees that relates to what we should be doing as we actually start our investment process. So with that, Nelson, I'd like to hand it over to you.
Thank you. It's a pleasure to be with you. I have managed to be in Australia once for when you were having an annual conference. I remember it well. Newcastle was a delightful place to be, and it rained all the time, but so I felt right at home. It was just like Scotland. So yeah, I'm looking to talk today about exit data and how that feeds back into potentially a philosophy for angel investing and thinking about angel investing before and after the event, as it were. But what I would like to emphasize is that whilst I'm talking about exits and therefore making money, I don't regard the financial return as being the appropriate primary motivation to be a business angel. And I base that around the 4 pillars that were initially established back in 1992 by the founders of Archangel as to why they were going to be business angels. And we still have those 4 pillars, and they basically are, we're putting something back into Scotland in particular. We want to use our talent, our contacts, as well as our money. So we only invest in companies where we can be fairly deeply involved in helping the company. We want to enjoy the process as much as possible. Of course, some people find masochism quite enjoyable. So, you know, we cater for all tastes and as a business angel investor. And then number 4 is making money. But, you know, if you look at it, that number 4 is actually, if you like, the last item, but it's also the foundation upon which all the others are built. And it's it's an absolute necessity that we are able to turn our passion for investing into hard cash, because without it, our processes and the industry, if you like, aren't sustainable. And at the end of the day, if we're not making money, then we're working with a whole bunch of entrepreneurs who are dedicating their lives to making companies work and not getting the return that they want. And when we're talking about the exit event and what it's worth, the exit event is usually presented at the end of the process. And often in training events and what have you, you talk about screening, you talk about due diligence, and towards the end of the event, you might start to think about exit. But once again, if you think about that idea of a foundation, everything above that exit, everything above the exit is supported on the fact that there's going to be one at some point. The difficulty that I'm sure everybody faces is that so often we get business plans and business concepts where, frankly, there is no exit plan. This wording was taken, apart from the name of the company, which I've changed to Dead Cert because aren't they all, word for word from a business plan that was presented to the UK Angel Co-Investment Fund. And I guess partly what was significant about that was that in the UK Angel Co-Investment Fund, we don't interrogate the entrepreneurs. We interrogate the angels who we're going to be co-investing beside. And the angels had quite happily accepted that this rather vague and completely meaningless exit strategy was going to be put in, was appropriate, because no effort had been put in place. And I'm drawn in many ways to saying we need some data to actually understand what exits are going to be in order that we can plan the journey. And this is a phraseology that I've stolen from John Houston, a well-known to many angel investors from the States and the founder of Ohio Tech Angels. And he was very passionate about actually using data, not just general data, but specifically data about Ohio. And for him, he was facing the same issues that I think we face globally. The founders come to us with these tales of fantastic exits in Silicon Valley, and we have to try and explain to our founders that they're not in Silicon Valley and we're not in Silicon Valley. So perhaps we should use something which is a little more relevant. So just a few weeks ago, I guess, some data was produced by Bohurst looking at nearly 3,000 companies that have exited since 2011 and gathering as much information as they could about those exits. Now, these are high growth potential companies. They are the type of companies that angels and VCs have invested in or would invest in. And frankly, it is very difficult to get reliable angel investment, because fundamentally angels tend to exaggerate their exits and underplay their mistakes, and it becomes difficult to get a realistic situation. So here's somebody who's done the work for us. And if we look at the headlines, then there's some good news, there's some bad news, and there's probably some of what we expected. But it is clear that the level of exits within the UK is increasing. There are more exits than there used to be, although there's still a vanishingly rare event. There were just under 500 exit events. And we're not talking about write-offs here, we're talking about something where some money came back in the whole of the UK last year. And if you think about the number of startups that there would have been in that year, that's a pretty small number. And the disappointing thing is that of the 3,000, we've only got a very small percentage of the data. 81% of the published data doesn't give us a value. And the suggestion is that it's the smaller exits that don't give us the value, because the bigger ones tend to be IPOs or large company sales, and you do get the data on that. And the fact that smaller exits aren't published is significant, as we'll talk about in a little while. There are more B2B exits, but B2C exits tend to be larger. And they tend to be bigger, and they tend to have required a heck of a lot more money. You know, so being in the B2C market may appear to be attractive because that's where you get the opportunity perhaps to ride along on the back of a unicorn exit. We will talk a little while in a bit about the level of dilution you would have faced if you ended up being an investor in one of these unicorns when it eventually exits. And acquisitions absolutely dominate. There were only 9 IPOs last year as opposed to nearly 500 M&A exits. So it is going to largely be, we're going to plan for an acquisition. So the data that they produced showed that 87% of all the exits that they were able to monitor over this period of time in the UK were actually for less than $200 million. So the idea that seems to be floating around that the unicorn exit is now the bar that everybody has to meet.
Join the meeting.
Is just a little bit fanciful. Excuse me. But if you break down that 87%, we find that the numbers are even smaller. 51% are for less than $30 million. Sorry, 30 million pounds, so say 40 million US dollars. And as we said earlier, this is published data. So the reality is that probably a far greater percentage of the deals that are being done are less than the 30 million pound level because the smaller deals are simply not recorded. And you know, there's a variety of reasons why many of the deals are smaller than expected, and notably in Silicon Valley, we've come across, in particular, we've come across a lot of what we call acqui-hires, where the companies are simply being bought for the management teams and being shut down because the management team, the engineering teams are more valuable than the company's product. And the Facebooks of this world will pay $5 or $6 million to take on a group of engineers, and it gives the founder the bragging rights to say they were acquired rather than sell out to the big boys. Now this is UK data, but there's some older general data here. This is from 2016 from CB Insights. And they looked at global data, and they had 50% or 54% of the exits that they tracked globally were for less than $50 million. And again, this is published data. And again, that report suggested that the average level was actually going to be lower than that 50 million because the small deals aren't being published. So there's a little bit of thinking to be done here. And sorry, the other graph was presented at an ACA meeting in the States, I think that Jordan was also at a few years ago. And it was suggesting that 66% of their M&As in America were for less than $20 million. So very small numbers compared to the headline numbers where we often see. And something that I think is pretty important when we're thinking about the capital structure of a company, the initial valuation and how much money we're going to have to put into a company to get to a potential exit value. And one of the things I would suggest is that this is not, as is often claimed by non-investors here in the UK, a result of a lack of ambition on the part of either the early stage investors or the founders. I think it's a reality of the marketplace. Like anything else, acquirers have a price they're willing to pay. And if large companies are looking to buy the technology, buy the product to put through their own distribution lines, they've got a comfort point at which they're willing to buy stuff. And when you talk to acquisition managers from the large companies, you tend to find them talking about a comfort level that sits in around about that $35 to $50 million. They're very happy to buy companies at that level all day long. It becomes much more difficult for them to buy companies that are bigger. So, sorry. Now they also provided this slide, which shows the mean acquisition value going back to 2011. And it hasn't really changed. It has stuck there at around the £50 million pound level for the average. Now the blue line is the IPO market. That's all over the place, driven by a small number of outliers. But the red line is the M&A market. The M&A market has been largely flat for the lifetime of very many angel investors. Now, it is often said, and in fact it is said in the very recently published Angel Capital Association report, that a good policy for angels is to have 15 to 25% of the equity of a deal when they do it at the beginning, to account for dilution and other factors going forward, and to make sure that you have a decent percentage when you get to the exit. And there's a slide here that I picked up probably about 2016, and it showed, it was an ACA slide, and it showed that although valuations at that time did appear to be going up steadily, it indicated or suggested at the time that the percentage that angels were keeping was around about that 25%, although in 2015 you can see it's dipping around to 20%. So there was a little bit, there's clearly been pressure on the percentage that angels are going to have that would question whether we're still getting our 25%. So apologies that the lower part of this slide is a bit fuzzy, but I've tried to expand the image to match the thing above. So above you've got the valuation, which has been pretty flat, and the slide below is showing the valuation for early stage deals in the UK. And if you look at the bottom lines, or the bottom line in particular, that's angel and seed line. So from 2010 through to 2019, it's gone up by 300%. And based on the early part of 2020, despite the COVID situation, they're suggesting that that number has actually increased even further. So I've got a fairly fundamental question I have to ask angels and early stage investors. How do you get a 10x return, which is what we say we need to get in order to get a portfolio per deal? That has to be the potential, I think, in order to try and get a portfolio return of 2.5 to 3x if your exit value has stayed flat and your entry value has gone up by 3x. There's something not working here. Now, is this just UK data? Well, it isn't. Back in 2010, a guy called Bill Payne, another very well-known American angel, did a survey, just phoned people up in America, angel groups, and he came up with a median valuation of about $1.5 million as a pre-money valuation for ACA angel groups back in 2010. By 2016, we're seeing a pre-money valuation of over $3.5 million. So this is a steady trend of increased valuations that's been going on in the States as well. And the most recent data from the States suggests that that pre-money valuation has now reached $6 million. Now, I don't have, unfortunately, the exit valuations, but I have no reason to believe, based on exits that I've seen angels getting and our own experience of selling companies to American acquirers, that their exit values have actually gone up either. And that American data, so their valuations have gone up 300 odd %. And recent ARI data suggests the same sort of thing. The ARI data allowed me to do some calculations, and it's suggesting that ownership percentage is nowhere near the 15 to 25% suggested. It's around about 9%. And then you're wondering, so how do you get a decent return if you only own 9% on day one, and you're going to be subject to future dilution? Geography plays a large part in this, and it is possible to look at valuation on geographic basis to some extent across the US. And I think this is important because so many of us use comparatives for valuation purposes. Founders globally will look at valuations and exits that they see reported in the press of various sorts. It's all Silicon Valley based because that's what gets the press. And there you can see that in California, the seed valuation is around $8 million. The round size is 700,000. So the ownership is about 8%. Just out of interest, I thought I'd throw up the structure there about prefs and notes and what have you, because there's usually a battle going on between people like myself who would never do a convertible note as an investment, and those who seem to be happy to do it, but it's about 50-50. So California and indeed the mid-Atlantic, New York, their kind of ownership percentages are not that far apart. The valuations are a bit higher, but so is the money going in. But I think it's interesting, if you stick in the Central American flyover states, the median valuations are substantially lower. The amount of money that's going in is a bit lower because it costs so much less to hire engineers in the flyover states than it does on the West Coast, and their ownership percentage gets back up to 15%. And this is what it's really coming down to. The idea that a company actually has a kind of actual value, I think, is a bit of a myth. What we're actually talking about is saying, how much money do you need to achieve your key milestones? You put that money in and you agree a percentage ownership, and that's how the valuation ends up. So the more money you put in, the higher the valuation. That seems to be that's the driver. But we've allowed that ownership percentage to slip away from us. And the last specific item out of this report is a diagram that looks at the highest value companies that they had in their sample. And the red dots represent high value companies that have actually exited. And the blue dots represent recent published deal sizes, or valuations rather, for large deals. So the blue dots have not yet exited, but that's the valuation they had the last time they raised money. And I think this is interesting because if you put in a kind of line where the exit values, the actual exit values are at best, perhaps, and that's probably tilted too far up when I look at it again, there's an awful lot of blue that is above the line of reality of what's exiting. So I think there's an awful lot of companies out there that appear to be valued way higher than they're ever likely to get exited at. And although these are very big value numbers, these are the kind of unicorn companies, I think all of us angels are guilty of having companies in our portfolio that we've turned into zombies because they've raised so much money we can't get an exit, because they've gone past the point where they can get a profitable exit for us. And I think we all need to just take a look at our portfolios to make sure that we're not, strangely enough, overfunding companies and making them too big to exit. because exit is a substantial problem, and I think probably many of you will have seen the data that has been generated over the past years, particularly by Rob Wiltbank. Depending on how he's done the survey, most recently he was suggesting that 70% of the investments that angels make in the US through organized angel groups fail to return capital. That's a horrible number, 70%. I don't actually believe that 70% of the deals we do have bad management, bad business plans, or whatever. I think that a significant problem is we're not helping them get to the exit because we're not planning the exit properly. We're not planning the capitalization of the company properly. And I started investing in 1996, did my first deal. There's a different presentation to be done on how bad that deal was. But by 2008, I was pretty much done. I'd done a bunch of deals, both in the as a private investor. I'd become a fund manager. I'd done a bunch of deals as a fund manager, and I wasn't seeing exits, and I wasn't hearing people talk about exits. The theme seemed to be that business angels were much nicer people than venture capitalists because we didn't talk about exits. We will grow companies and someone will come and buy them, build it and they will come. And strangely enough, nobody was coming and nobody was buying. So by 2008, I had pretty much given up angel investing, which is kind of ironic because it was 2008 that they made me European Business Angel of the Year. So I lost even more money going on the speaking tour for the next kind of 18 months or 2 years. But 2009 for me was a transitional year because in that year we saw a bunch of books come out. Scott Shane wrote a book that was hugely unpopular at the time, pointing out that 40% of angels only ever lose money. The Early Exits by Basil Peters' book came out suggesting if you want to make any money as a business angel, don't let a VC near your company. And Tom McCaskill's Invest to Exit and other books came out, which was really a foundation stone for my philosophy now in terms of think of the company as the product and build that product for the buyer, which is the exit event, and a bunch of other books. And Jordan was around at some of the meetings in the US, and this to me fundamentally changed the way many angels looked at angel investing, and we brought the idea of looking at the exit much more to the fore. So if I go back to this was, and I think for many angels still is, how the investment process is thought about. It's a series of stages, and the exit is, as I say, tacked on at the end. And the typical business plan presents the case like this. You're going to have initial funding, and then you're going to have an exit. And there's usually very little discussion in there about the fact that actually you're going to need multiple rounds of funding and multiple types of funding, and it's going to take a heck of a long time because the exit is not talked about. So I've changed I've changed this process, and I think of it like this. So it's all the same boxes, but everything circles around the exit. Every element of the investment process is now influenced by the probability and the necessity of getting the exit. So I'm thinking about, am I as an angel likely to make money by investing in this type of business before I even go hunting and screening deals? Does my legal documentation have all the things I need in order to help drive and secure an exit? Post-investment, are we driving the exit? And back to the kind of discussion today, what's the link between exit and valuation? So how does this influence the investment decision-making as we go forward? And we may not be sitting in a position where exit is never discussed. You get a more sophisticated founder or group come together. And we've got here the West Coast capital plan, where you've got the initial funding, a second angel funding, and then of course a venture capitalist comes along and is terribly nice, invests in our business on wonderful terms that are completely non-diluting to the angels. And then we have a unicorn exit. And, you know, the whole process probably now lasts about, I don't know, 3 years. And we can walk away millionaires. Of course, we all know that the sad reality is somewhat different. The sad reality is a series of unplanned fundings where nobody else is interested in investing in our business because we haven't achieved anything that the next round funders or an exit partner is actually interested in. And we scrabble together, keeping the company going for as long as possible, and at best turning it into a zombie, which sucks in our time unnecessarily or to no benefit. And in reality, we're, you know, aiming to be flushed with non-success. So I think that when we start investing, we look at the business plan. We now look at the business plan and say, with this amount of money, how many of these steady states can I reach? With the money that I'm putting in the business today, can we get to cash flow break even? It's not necessarily a great investment, but at least it's alive and you've got time to work out what to do next. Can we create something that somebody else is going to invest in? Now that might be yourselves, or it might be a VC. But if you're thinking it's going to be a VC, you better create something that that VC wants to invest in. So what are the KPIs that your company has to meet to be interesting to the next round funders? 3, can we get an exit? And what does the company have to look like to get to that exit? The only other position I think the company can be in is bust. If you're not cash flow generative, raising more money or exiting, I think you must be dead. Now that has a certain concern that we're building to flip. We're not interested in scaling businesses of size. We're going to miss out on the big opportunities. So I've developed that diagram into more of this kind of fish scale diagram where, let's imagine you get to the point, you know, you've actually met all 3 of these criteria. You are cash flow break even. Somebody is offering you another 5 or 10 million bucks, and somebody else is offering you 25 million to get out now. Which do you take? Well, I developed this idea after hearing about a company that met with its investors and said, you know, we're in this position. We've been offered an exit, but we've also been offered more money to grow, or we could continue to generate some revenue. What do we do? The main VC funder wanted to grow it more. The founders just had decided that they thought they kind of wanted to take the exit. And in the end, they took the exit. And that was the first exit of a small company called Skype for $2.5 billion. And I've always wanted to be sitting around that boardroom table discussing, do we take more money or should we just accept the 2.5 billion? Normally I'm sitting around the table working out how we're going to pay the wages on Friday. So what I want people to think about is, every time you start raising the next round of money, when you raise that second round of funding, you have to go through the whole decision process again. You've been handed another $5 or $6 million. Therefore, what can you do with the $5 or $6 million to get to cash flow break even, the third round of funding, or an exit? And I think this is not being done, which is why you see a lot of companies raising too much money. They're raising money on the basis of, well, more money must equal a bigger exit. If somebody's offering me 25 million today, then they're bound to offer me 100 million later. What I'm suggesting is that at each stage, including the first round funding that you're going to do, but every funding thereafter, you should have a forward-facing spreadsheet that calculates your dilution and the founder's dilution going forward. So it's a forward-looking cap table, looking at scenarios. And that can be pretty scary, and it's worth doing with your founder, because obviously founders don't understand that the fact that the company's worth $1 billion doesn't necessarily mean that they're going to get more money from an exit. And in fact, we had a supposed unicorn exit here in Edinburgh, and the founders and the early shareholders got precisely zero because of the preference shares that had been put in over the top of them by the massive amount of funding that they'd had. And as you go through the process, remember that probably the exit value hasn't changed over the last 10 years. And consider that there's research that suggests and demonstrates that the fact that you put more money into a company does not necessarily mean that you're going to get a bigger exit. This particular study suggested that companies that had raised between 2 and 3 million were getting better exits than those companies that had raised 4 to 5 million. Remember, there's an increasing list of very large companies that are now worth absolutely nothing. This is just a small selection, and there's hundreds listed on that website. And as I mentioned, we had FanDuel, which discovered that if you sell for $500 million, but you raised $450 million, the founders don't get anything back because of the preferences. And this slide from Tom McCaskill from Basil Peters' book, every dog has its day, as they say. And companies very often ride over the value point where they would have got the highest value exit, but they just go too far. You know, if you're selling early and you're selling the technology and the IP, you're still selling the excitement and the newness into the corporates. So at every stage, including the first stage, I think we should be asking ourselves and the founders to come up with who are the most likely cash buyers? What do we need to build to make ourselves attractive to those cash buyers? And how much time and treasure is it going to take to build this thing? And I don't think we do that enough. And then actually go out and do some due diligence on the list of potential acquirers. We're very, very frequently, I've heard founders claim that they'll be bought by a certain company. And if you do a minuscule amount of due diligence, you can find out that that company has never actually bought anybody else before, and certainly not in your country. So the probability of you being the first company that ever gets bought is highly unlikely. And then when you're talking to the founders about the valuation comparatives that they're going to use, it is very important to base that on actual industries, not just a general number. Oh, well, companies are. So try and dig into the data to make sure that what you're being compared with is appropriate for your industry. And the reason I put this slide up is that that shows the average pre-money valuation and the median pre-money valuation. And we should be making sure we're using the right one of those numbers, because the median seems to be the one we should be using, whereas the founders are all going to be looking for the average, because that tends to be bigger because of 1 or 2 massive outliers. So let's make sure that we're using the correct type of data. Geography, obviously. Just because it's, in this case, 10.7 million valuation in Silicon Valley doesn't mean you should be paying that. I've got an angel group that I'm very close to here, Par Equity in Edinburgh. They do deals across the UK, but they have a pretty firm rule. They don't do deals in the golden triangle of London, Cambridge or Oxford, because their valuations are just stupid. There's a whole lot of really dumb money coming out of the London city, going into angel investment because of the tax breaks, and it drives the valuations nuts. So it's what is the valuation in Melbourne that is appropriate for you guys, not what is the valuation somewhere else. And it's, you know, this was just a quote that came out of a newspaper report about how much it costs to actually run a business in Silicon Valley. You know, in Silicon Valley, if you've got a household income of less than $100,000, the housing authority considers you a poor family. So it obviously costs huge amounts more money to develop a company in Silicon Valley than anywhere else. Silver Speak is an organization that publishes a lot of data. This is an old slide, but it showed who the major tech acquirers were, how many they'd acquired, and some of the companies they'd acquired. So you can actually either do this work yourself or give it to your companies and board to say, okay, go and find out what you need to look like. Where are these companies? Who's buying them? And start building that. And be very aware, I think, of the capital risk. When we're doing due diligence, there's a tendency to focus on management risk, product risk, customer risk, competitor risk. I rarely see angel investors thinking about the capital risk. How much money do we need? Where are we going to get it? Will we suffer massive cram down when the VCs come on board? We're talking to a couple of VCs about the next round funding. Have we actually looked at the type of terms that they impose? I recently saw a deal that was done and the VC had taken a 8 times preference on the deal. The angels aren't going to get any money back from that. And then post-investment, I do think you have to actually really drive this. I think it's really important that you put people on the board and have a regular discussion about the exit and keep the plan in place. You actually have a budget for exit. In order to get bought, you have to be noticed. You have to be in the right place. You have to go to the right events. You have to publish stuff. You have to collect data. So for me, the board should have somebody on it who is responsible for that activity, and that there's actually a budget line to go out and drive this and pay the expenses. I've put it last there, written exit strategy. When you first do a deal, you've got the money in your bank account. So the founders are always going to say, yes, of course, we're exit orientated. We understand that you guys need an exit and all the rest of it. Once the money's in their bank account, that conversation can break down quite easily, because suddenly running the business is actually quite, that's how they make their living. So I think you do have to constantly bring it back onto the boardroom table and make sure everybody's still aligned to it, and that options, for example, share options should be exit orientated, not turnover orientated, for example. The questions you ask in the board should not be, tell me about the new customers we got last month, but tell me about the new customers we got last month that our exit partners might be interested in the fact that we have. Remember, we're building a product, and that product is the company. So that all kind of circles back. If you're not focusing on the exit, then you are becoming unbalanced, as I think we've seen from the data, between the amount of money you're putting in, the valuation you've put it in at, and the credible potential return you're going to get. And obviously that affects the founders even more than you guys, because hopefully you guys have got a number of companies in your portfolio. So if you don't do so well on one, you're going to make it up on another. The founders only have one company. So if the exit numbers don't look attractive, they're just going to take their salary. They'll turn it into a zombie, and you're going to be stuck with it, I guess. So to finish, I'm just going to ask you, don't leave the exit to the end. Thank you.
Excellent. Thank you very much, Nelson. First of all, my apologies to everybody. There have been quite a few people who haven't been able to get into the meeting, but we will be sending everybody a link to the recording. But for those who are in the meeting, if you'd like to ask a question, I'd ask that you just open the participants panel and raise your blue hand. And while you're doing that, Nelson, we do have one question from earlier in your presentation. The question relates from Horace, is about the question of valuation. He's asking, how can we have a 25% goal for the amount of company that we want to purchase? Shouldn't that depend on the value that the angels add, both in terms of their network and expertise?
In a way, no, because very rarely does the network or the value that the angels put in get any attribution of value at all. If you're putting in the attributed value that angels put into companies, you'd be getting a much higher percentage. But you know, the 25% you can base simply on the financial return. You're looking at a situation where 50 to 70% of the investments that angels do fail to return any capital. Then the balance have to be able to return all of the capital that's been lost, plus all the profits that you're looking for. And on that basis alone, you're probably looking at needing to grab 25%, particularly if you start building in the dilution that's going to come later. Now, I'm talking here, I'm not talking about you get 25% if you put in $50,000. I'm talking about a sensible amount of money going into a company. You're putting in 100 and a few hundred thousand, then that's when I think you get the 25%. And certainly that's the level of investment that we're seeing, that we would be aiming for.
Horace, did you have a quick follow-on you had?
I'm a little bit shocked at that response, I suppose. You know, it's like if your 25% is actually determined by the fact that you've chosen others who failed, why isn't that a problem of your ability to vet the investments, and we're blaming your grab of 25%. It hurts the companies. Nelson.
Oh well, the position is that nobody can not choose losers. And you know, if you were only to do deals that you weren't going to lose money on, you'd probably never do a deal, and you certainly wouldn't make any money at it. I'm looking at the data of hundreds and hundreds, thousands of deals that have been done by professional business angel groups across the USA, and they cannot pick winners. They are ending up with 70% of the deals not returning capital. And that's consistent in Europe and elsewhere. That's the reality of angel investing. There is so much that goes wrong with companies that you just can't pick a winner.
Thanks. So I think we'll move on. Horace, happy to have this conversation with you offline. David, you've got a question.
Yes. Yes. Oh, good. I've got 20 questions. That was an absolutely fantastic presentation. I have never heard anybody say that before. You've just encapsulated in that brief presentation stuff that I've been working on for the last 10 years or more, and which have really come to a head in the last couple of years. I've done more than 12 angel investments, and I've done none in the last 3 years. I'm exactly where you were, as you described, in your sort of down phase. And I'm trying to figure out what to do about it. I've just been given a role in the investment team, and I'm hoping I'm going to be able to talk to you about that and get some further guidance. My question is, do you exit locally? Do you see a role for the argument that says, oh, well, the market for product X in the US is so much bigger than it is here, so we've got to go global, so of course we're going to the US, and since we're going to the US, the last round of funding will be in the US, therefore our entire strategy should be around going to the US and exiting in the US. Is that what you expect your businesses to do, or do you expect acquisitions in the, as you said, in the 10, 20, 30 million pound range from local business acquirers? And of course, how does that translate to Melbourne, which is a substantially smaller market than the UK and Europe?
So I think this depends very much on what type of company you're investing in. I have, let's see, one of the exits I have was a timber frame house builder, or built the timber framed house kits for national builders. It was obviously selling them to UK house builders, and the acquisition was a UK exit. If you're building a medical device, then the acquisition partner is likely to be a medical device company. And we don't really have any large medical device companies here in Scotland, so that acquisition is almost certainly going to be an international player. Most of the international players are US based or European based, but strangely enough, buying it to get into the US market has been our experience, because most medical devices, because of the health service structure in the US, yeah, it's usually the first market we find, because it's of the nature of the structure. So I think you've got to look at the nature of the company and then who the buyers might be.
And the last round of funding?
Sorry, say again?
Funding.
Yeah.
Typically, we're told that to get into US markets, you're going to need, for whatever better term, VC funding, or at least non-angel funding, not beyond the level of funding we can organize, like 3 million and enough.
Well, I think many companies do underestimate the cost of operating in the US, but again, I think it depends on the nature of the company, and and I think it's a way of what is it that you're selling and what you have to demonstrate. So I think from capital efficiency point of view, a lot of companies they think in terms of building revenue and turnover numbers, because they think that the larger the sales number is, the more valuable they are. And our experience is that that is not the case. What is important or critical is the quality of the customer. So it's more important to go after customers that are perceived by your acquirer to be of value than simply build turnover that nobody cares about. I've said in the past that going after the low-hanging fruit may not be terribly useful because nobody wants to eat it, which is why it's still low-hanging. So, you know, the Archangel exited out of ZoneFox, which is fundamentally a computer security company. It was sold not because of the turnover, but because it had 5 or 6 highly prominent, highly visible international customers. Now, if you're selling your SaaS type product to international customers, you may not need a massive overseas presence. You probably need some boots on the ground to go and visit the clients and what have you, but you're not setting up manufacturing. You're not necessarily having to have a big infrastructure in the States, so it would cost you less. But yeah, I mean, I can't really speak for Australia because I've only been there the once. This was a conversation that I had several times when I've been in New Zealand, and a comment I made to the guys who were then running the New Zealand Angel Co-Investment Fund was that I did feel that the companies weren't raising enough money to meet their plan of going to the US. They were raising, you know, $150,000, $200,000 and saying that's what we need to conquer the US, whereas they probably need that amount of money to work out just which state to operate in.
Okay, so in the interest of sharing it around, Peter, you have a question you'd like to ask.
Thanks very much, Jordan. Nelson, I want to add my comments, please. Absolutely brilliant presentation. Thank you, and particularly the data. 2 questions. One, are you prepared, please, to share with us your personal experience of your portfolio performance. So average times return, your personal experience, and over what average holding period. That's number one. And number two, do you personally believe that the quality of due diligence makes a difference in potentially avoiding some of the losers and choosing better candidates? Thank you.
I'll deal with the due diligence question first. Yes, I believe that an appropriate screening process will help you weed out many of the companies that are not going to be successful. And this is partly a self-defense mechanism, if you like, because many of the government programs and others aren't, I think, helping companies realize that they're not appropriate for third-party equity investment, for example. So roughly speaking, everywhere I go, it seems to, you know, in America or in the UK, of all the startups that there are, about 4% are ever going to be able to take third-party equity. And of that 4%, a smaller percentage actually understand that by taking third-party equity, we're going to have an exit, which means selling the company somehow. So part of the screening and the due diligence is simply weeding out the ones that we ought to be sending off to do, you know, another form of funding. But, you know, you just don't know what the risks are going to be. You know, I haven't got it prepared just now, but I do have a slide that shows all the losses I have and you know, brief explanations, and it can range from you know, I've lost money because governments have changed legislation, because we can't get a molecule through the blood-brain barrier. I was involved in a company in the, when did we invest in it? About 2000, 2001. That company was fundamentally what is now PayPal. It was just that we were far too early and we were aiming at the business-to-business banking market. And then the Americans came along later, our company having gone bust. The Americans came along later and cheated by doing it better at a better time in a better market with better technology. But, you know, hey ho, so there's all sorts of, and you can't pick this up in due diligence. You just got to accept it. Now you can duck and dive a bit. I've been involved in a company where it started off as a life science company looking to do medical diagnostics, and ended up doing work in the oil industry, analyzing the cuttings that come out of drill rigs, because it was able to flip in a different direction. In terms of my personal portfolio, I've never actually sat down and worked out an IRR. There is a report, and I'm happy to send it to Jordan. You can share it. It was done on Archangel a few years ago by a business school, and they looked at every single transaction they had done between 92 and I think 2014, maybe 15. And they had the Archangel then had an IRR of 21%, which compared to the IRR for the British Venture Capital Association of the same period of 14%. I've had, as I said, 10 exits, one, a couple at the 1x level, which I regard as a win, and one at 92x, which of course was the smallest investment I ever made. So hey ho. And I've had an exit in 53 weeks. The company actually phoned up and almost apologized for taking the exit offer. You know, sorry, it wasn't in the business plan. And I've had one which took 20 years to the month. But we had 5 or 6 times our money back as dividends during the period. And given that it was in the house building industry and we went through 2008, that's not bad. And then we eventually sold it. So it's all over the place, frankly.
Excellent. And Michael, you've been very patient. You have a question.
Yes, thanks, Nelson, for those insights. Are really very, very valuable. One of my observations is that many founders have a personal objective, which is more to do with participating and experiencing the journey that they, would expect over a period of, let's say, for argument's sake, 5 to 10 years. And that in fact, a primary objective of theirs is not to take an exit after 12 months because they don't get the experience or necessarily the knowledge that comes from operating a company. So that's one of my observations. And so I think perhaps one of the outcomes from what your presentation is saying is that as angel investors, we need to look out for those founders who have that mindset versus those founders who are very open and who are looking for a financial outcome as quickly as possible. Would that be a fair comment?
Yeah, I'm not pushing the fast exit. I think the idea of having an exit in 12 months is going to be, well, whilst it might be delightful for everybody concerned, it's going to be an accident. And that Archangel report suggested that our average time to exit was 8 years and 3 months or something like that. And 8 years seems to be about right if you consider at best that, VC who's coming in later on has a 10-year fund life and all that sort of carry on. So 8 years is kind of where we seem to be at for the type of IP rich companies we develop. And I would say two things about the nature of founders, and it is worth having, I think, quite long conversations with founders before you invest. You've probably come across the book, I think it's called The Founder's Dilemma, which is based on some research in the US. And it divides up founders between those who want to be king and those who want to be rich. And the kings never want to give up the position of CEO. And we will always have a conversation with our founders about when, not if, they will give up the CEO position, because it's highly unlikely that a founder will be able to take a business from zero to full growth potential. Because most founders that we're dealing with have a technology background, they don't have a business background. So you get to a certain point where you need a completely different set of skills to build the business, understand sales, understand manufacturing, understand customer service. So part of our job is to ensure that the founder's ego doesn't get too tied to the title of CEO, and that we take the founder with us as we jointly search for the next mug who's going to be the CEO of our companies, while the founder will always retain the primary title of founder. And in fact, one of my best exits was in a company called Optos, and the founder of that was so disinterested in the IPO on the main London stock market that when it went onto the main London stock market, he was actually doing a little expedition in Antarctica because that was much more interesting than floating a company. And the other comment I would make about the person who wants the experience is I talked to a lady in Silicon Valley. They run an angel group there from the 1990s, and they said they look for 3 things in founders. The first 2 are essential, and the third one's a nice to have. And the essential thing is, 1, you've worked for corporates, so you understand how corporates operate. You understand how corporates buy. You understand corporate decision making. And I have to explain to my founders that working for a corporate is not the same as working in the fulfillment facility for Amazon across the river here. You have to have some sensible corporate experience. Secondly, and it's a requirement of theirs, they have to have worked for a startup before. They have to have worked in a startup and seen what happens in a startup, which is interesting because if they're now not working for the startup, the chances are it's gone bust. So they've been through that process as well. And the third one, which is a nice to have, is that they've been a CEO before. So they're actually requiring people. And when I was in Silicon Valley, I came across young founders or potential founders who were building their startup CV. They were working with a corporate. They were delighted to be being hired by other startups, particularly those that were being VC backed, because then they could turn around and say, as part of their own business pitch when they start their own business, which they have the idea in their head for, I've already worked for a startup and that was backed by, you know, Sequoia or something like that. So, you know, we have a problem in Scotland that we don't have very many corporates, and we don't have a culture of people working for multiple startups. So it's one of the jobs we have as angels, is to fill that gap, because our founders simply don't have the knowledge of how to sell to corporates, for example.
Great. So I think what we'll do is we've got two more people who've said they want to ask questions. So let's see if we can get through those. And then I think we should let Nelson call it a night, because let's keep in mind it's well after 2 a.m. his time. Liana, you've got a question.
Thanks, Jordan, and thank you, Nelson. Some fantastic messages there. Really good presentation. I reiterate everyone's comments. I'd like to get your feeling a little bit for potential tension between how much time and effort you put into looking for an exit when an angel investment's often quite early, versus growing the company. And you mentioned the company, a life sciences company that turned into the oil industry. Well, you could spend a lot of time and effort cultivating the exit relationships in the life sciences, and then they would be useless in that circumstance. So that it's really just balancing that sort of thing. Appreciate your input.
Well, strangely enough, I think I've found that identifying the potential exit partners to be both more essential in a way and easier in life sciences. And the reason I say that is that if you're developing a drug or a molecule, for example, there was something we were involved in that was in relation to diabetes. In order to sell, in order to sell the company, you're probably going to sell the IP at some point. You're not going to be selling a product that you're putting into people and is actually on the market. So you need to understand, I think, is a buyer going to take this off you at stage 1 clinical trials, stage 2 clinical trials, stage 3 clinical trials? Because the capital required to generate the data at each of those stages is phenomenally different. And if you say, well, no, the only way that this product is going to be taken on is if we've got to stage 3 clinical trials with a lot of data, and that's going to cost us $50 or $100 million to do, then how much of the company are you as business angels ever going to own by the time that happens? And how much, what level of preference is above you, and therefore should you be doing the deal?
Nelson, my question though was not actually that sort of issue. It was more that companies, early stage companies, can end up being successful often on something else than what they started on. And you gave the example of a life sciences company actually going into the oil industry. So yeah. My question is more, not so much what stage in a life science company, but if you were cultivating exit partnerships that were related to life sciences, and at the end of the day, the company's successful in the oil industry, you could have put a lot of time and effort and distraction into that process when, you were cultivating the wrong group in the end.
Yes.
Yeah.
I have to tell you that, unfortunately, that life science company that went into the oil industry and did actually have investment from 2 oil majors, did actually close down last year, having failed to go anywhere because there just wasn't enough revenue in the product they delivered. The answer is to your question is yes, and that's why I think you need to involve your board in the process. It's not you don't want to distract your CEO by running around constantly trying to find an exit partner, because apart from anything else, they've never done it before. So what makes you think they'd be any good at it? So I think that's why I think your non-executive directors should probably take on that responsibility and build it into their routine.
Thank you.
Great. And so, Paul, if you'd have a go, and then I've got one more from Richard.
Thank you, Nelson. Great talk. As angel, 2 or 3 tips for going through an exit as an angel.
Going through an exit as an angel.
Approaching an exit.
Yeah, I think the I think you have to, okay. If it depends where you, if you're actually in, if you're talking about the exit transaction itself, then I think it's important that you resource it properly. I would suggest that the CEO and operating managers are protected from the process as much as possible, because you need them to keep running the business. And because you do not want to reach the end of the investment process and find that they've taken their eye off the ball and your sales numbers have fallen or something like that. So you need to form an exit team. And that's why I've suggested in one of the slides that you, when you're thinking about the non-executives you put on the board, think of it as a tag team. So at certain points you change the non-exec to match what the company needs at that point, which may be, you know, at one point it's technical development, another point it might be manufacturing. Let's put some exit transaction experience on the board, get them to lead the deal, and understand the tensions that will be within that process, because bear in mind that when the exit happens, the likelihood is that you, the angels, will leave, but the CEO and the management team have to stay. So it's quite tough to do hard negotiation with your future employer and keep them on side. So I would suggest that it's a case of looking around who you've got on your team within Melbourne Angels who are going to come in and help you deal with that.
Okay, so now one question, Nelson, one last question on the sort of the context of valuation. So Richard is curious, to what extent do you think that angel valuations have been bid up while exits remain flat, which is what you've shown in your data, as a result of other asset classes having much lower returns due to the low interest rate environment we're all existing in?
I would look, I can only really comment on the drivers for what I see in the UK. Within the environment that I operate in, which is, you know, I fundamentally invest in Scottish companies. We have a highly networked and highly cooperative investment community. We have a philosophy that we will put into the first round of a deal as many angels as want to be in that round. And where necessary, each individual will reduce the amount of money they're putting into that round. And if that means we cooperate with other angel groups as well. So we'll frequently have 2 or 3 or more angel groups involved in the same deal. Therefore, we don't have competition for the deals, and we don't have any significant pressure on getting deals done, because there are very few angels acting individually and there are very few funds. Down in England, and particularly London, what I'm seeing is money chasing deals, which is tax incentive driven. It's by people who aren't thinking about the process. They haven't thought about what it means to be a business angel, and they're being encouraged to do deals by brokers and other organizers. And I think that drives the money up. I think that drives the valuations up. And I think the nature of many of them, I see a lot of people through the UK co-investment fund, and they're described as experienced because they've worked in the City of London. They've worked on derivative funds or something like that, which is just a little bit different from investing in an early stage tech company, in my view. And I think the press has a lot to do with it, because it emphasizes these big deals. And the idea of chasing unicorns makes it sound as if it doesn't really matter what the early stage valuation is, because companies are worth $1 billion. But what you don't get told and isn't published is what the terms are on that $1 billion valuation. So if you're the last VC into a unicorn and you've got terms that say, I've got a 3x preference on that, or I've got a guarantee on an IPO, I don't care what the valuation is. So these idea, you know, we're building a situation where the headline is the valuation, but we're not getting the detail of how the deal is put together. So if you've got a 3x pref on your terms, the valuation's largely irrelevant, because as long as you stay at the top of the cap table, you're going to get 3 times your money back, which is pretty good for a VC.
Great. And look, Richard, one other comment I'd just make, or one other observation about that beating up the valuation, is what Nelson's been talking about is actually having an investment strategy, a thesis about what works when you put money in, how much money you put in, how much of the company you buy, and what you're expecting out the other end. And if you have that thesis and that strategy and you believe that it's what works, then the valuations are actually dictated by that overall approach rather than extrinsic factors or competitive pressures. And that's certainly the way that we generally try and approach it at Melbourne Angels. But we've run well over time.
Yeah.
I thank you all for sticking around.
One other thing about the investment strategy. I referenced earlier that our philosophy is to get as many angels into the early stage deal as possible. So the last deal I did, we had 57 angels involved in it. Each angel, you know, a lot of the angels will, you know, they're putting in amounts in that deal ranged from $5,000 to $75,000. But certainly my strategy is you put a small amount of money, let's say you put $10,000 into round 1. I'm reserving five times that amount of money for future rounds of funding. Because round 1, all I'm doing is buying a ticket to do round 2 once the company's worked out what it's going to do and if the management team's actually any good. So come round 2, we double down on the money. And that's kind of worked for us. What I see in America and in Europe is that angels do it the other way around. They put more money into round 1 and then don't have enough capital to follow through on the ones that are actually making progress and developing and creating value. And they end up being diluted. So if you look at the Archangel data in the report that I'll send to Jordan, you can circulate it. The report identified that, I think it was 40% of the companies they had invested in, they had lost 40%. But because of the way the deals are structured, where you put in a small amount of money and then build on success, they'd only lost 15% of their capital. So that's a very substantial difference. So when you say that 70% of the companies have failed to return capital, that doesn't mean you've lost 70% of your capital if you structure your investment process correctly. So you put small amounts of money in round 1, and then on round 2, you put a bit more, and round 3, you put a bit more. And certainly our strategy is we do deals where we think we can be and have a seat at the table at the exit, not simply rounds 1 or 2. So we look for capital efficient deals where we think we can build a company over up to 8 years. We'll sell it on a strategic exit IP basis. And between us and our co-investment fund in Scotland and our fellow angels, we will be able to put in $5 or $6 million. And that gives us an exit around the, you know, 35, 40, $50 million that gives us a decent return.
Excellent.
Okay.
Thank you, Nelson, very much. And I hope you'll join me.
I need to go now because I've got a paper round to do.
It's still a bit dark in Scotland if you run for the paper. But thank you, everybody. Thank you, Nelson, very much. Really appreciate it. Everybody have a wonderful festive season. I look forward to seeing you all soon. Bye now.
Thanks, guys. Cheers.
Thank you.